Hi, it's Josh here. I'm going to show you how to add a property in your individual name. So we want to scroll down to the bottom of the page and we want to ensure that we're in the Properties tab. This is where we control all of the relevant information around the property. So you can see that there's a bit of a table here, and this is where our quick actions are also. So we want to add another property. So there's an Add New Property button here. We click on Add New Property, and this will open up the wizard to enter in the new property. The key difference between an individually purchased property and a trust purchased property is that when we're using individual name, it's pretty basic and we're following the bouncing ball, and our borrowing capacity is already calculated by the system. Now, when we're doing a property purchase in an entity, such as a trust or a company, there's an additional step that is added in it called the borrowing power optimizer. Now, the key thing here is that the step does not pop up unless we already own properties in a trust or a company and we're purchasing in a trust or a company. Otherwise, that step is not included. It's not relevant for adding individual properties. So one thing I want to highlight here is that the purchase date is always going to be sequential. So when we purchase a property today, our next property purchase has to be tomorrow. We can't just stick in an extra property purchase in a previous date. And the reason for that is we're potentially using equity from one purchase for the next and for the next and for the next. And it doesn't make sense that we're going and sticking property purchases in. We need to be very systematic and think about the portfolio plan in the order that we want to do it. And it's a bit of a structured process. So in this instance, we're seeing that we can only do in November 46 because the most recent portfolio activity, as you can see here by the helper, is actually on the 1st of the 10th 46. So now we're going to do 1st of the 11th 46, and we're going to add in investment 6. Now we select the property type. You can choose from multiple property types, but we're going to stay with residential in this instance. And then we can pick ownership structure. For now, we only have individual and trust. Company is coming soon. So now we pick our ownership structure as individual, and we're going to select the owner. In this instance, Nick is the only owner in this property portfolio. However, if there was another member, you can add another member if you wanted to, and you select the relevant ownership percentage of the property. Now, this could be 90-10 or 50-50, and all of the tax calculations in the systems are basically done in accordance with the ownership percentage and what their earnings are. So it's really important that we enter in this information when we're purchasing and just take a little bit of time to ensure that we're purchasing the property correctly because your cash flow is affected if you don't. So now we want to save and continue. And now this is the use of the property. So we want to identify, is it for a principal place of residence or is it an investment? The reason being is that we have multiple rules around your principal place of residence, with capital gains tax discounts and things like that. So we really want to highlight that you ensure that you're selecting investment or principal place. We go to next. Now we can see that we've got available borrowing, cumulative savings balance. This is your total savings balance, and your usable equity. This is quite a mature property portfolio, and that's why we've got quite a significant amount of usable equity and available borrowing. Now, what we want to do is we want to establish what loan to value ratio we're going to be using and also what the intended purchase price is. For the sake of this, I'm going to use a $700,000 purchase just to give you an example. We have used 88% in this instance. Now you can reduce this to 80% if you like, or you can go up to 88%. You can actually exceed this loan to value ratio. However, we could only extract equity up to the 88%, as this was covered in the assumptions video where we put in 88% as our maximum limit. In this instance, we want to use a buyer's agent, and we'll be getting a main loan. So the main section of the financing will be $616,000. And then we have the buyer's agent fee and other associated costs of $61,500. And then the actual deposit component, which is $84,000. So total, we need $145,500 to get the property deal done. And so we really need to ensure that we are conscious of our savings buffer. And what I mean by this is that we need to ensure that we've got enough cash in savings to get us through those tough times where we might have maintenance issues. So we need to consciously monitor this when we're doing purchases. Now, noting that we have a significant amount of available borrowing, And we also have a lot of usable equity. In this instance, we're going to use equity to purchase this property. As you can see here, the user's equity from other properties, the max we can extract is 1.62 million, but we only need 145,500. So we're going to click on this and we're going to add an equity loan to another property. And we're going to use the investment for. And we put the relevant details. So we're going to say, we're going to go interest only, and we need to extract 145,500. You do not need to do the whole amount. You can do partial. And you can also do it on multiple properties. So let's add the interest only period of 5 years in. As you can see, we're topping up another residential property 4, and that's going to increase the loan on that property by 145,500. And we extract that as cash as a deposit, meaning that we don't need to use any actual cash savings. We've done it over a 30-year loan term with an interest only period of 5 years. So now our savings buffer has gone from 36,000 back up to 181 because we're not using any cash out of our pocket. Now this is the main loan. So this is the larger portion of the loan that is secured against the property. And so what we want to do here is we want to pick what we want. We want to go interest only in this instance, 30 years with a 5-year interest only period. And we also want to change the interest rate to about 6.19% in this instance. And then save and continue. Now what we want to do is change the value of the property as we see fit. Many buyers agents and investors try and buy properties under market value. If you think the value of the property is slightly higher and you can verify that, by all means stick the property value in, and we will be running off not the purchase price but the property value, as the value trumps the purchase price. So in this instance, we're just going to leave it at what the purchase price is. And we're just going to run with a 5% growth rate. However, if you wanted to add additional growth rates in over different years, you can add additional growth rate periods. Now we've got a rental information here, and we've just got to identify what the yield is that you want to use. So for example, we would say a 4% yield, and that ends up being $538 per week. And we're going to do a 3.5% growth rate. Now with the expenses, we can use two methods. We can do a general and we can do a breakdown. A lot of the time breakdown, which is all of the actual breakdown, you can put repairs and maintenance and the frequency in. We can use this for our actual portfolio of properties we own, but for hypothetical properties, it is a lot quicker to use the general. So let's just ballpark this at $10,000 for this property annually with the expense growth rate at 3%. Continue. Now, the depreciation amount, this is obviously a bit of a guesstimate at this stage for a hypothetical property in the future. I suggest using a small amount, noting that you're unsure about what you're going to be purchasing in 20 years' time. So I'd be using either $0 or say $1,000 or something very small, just so that you don't affect the modeling too much, and that if you were to get any advantages from this, it would obviously improve your cash flow or your situation. So there we have it. We press submit, and now we've got an extra property in here, which is property 6, and it's now on another property purchased. So the important thing here is to note is that we really want to just be following the bouncing ball, and by adding a property, we can follow every step along the way and submit, and then that is a repeatable process. The real question is, when can you purchase next? And using the chart to establish when you can purchase next, what's your max purchase price at a point in time, you can use the chart to establish this, and then you can go back in and add another property. I hope this helps. Thanks.